Welcome everybody. My name is Powell Chi. You have joined Multifamily Masters Live. Today we are going to be talking about offsetting your taxes through real estate. And we have a special guest with us, Brandon Hall of the Real Estate CPA, here to answer questions too. But before we do that, let me just mention here that our group is called Multifamily Masters. I like to say that we're the universe's fastest growing multifamily meetup group, and nobody can really dispute that, I hope. But I like to kick it off with that. We do have a Facebook group where you can meet and chat and start discussions and ask questions and kind of connect with our whole community. We have about a little over 6,000 people in there. We have a meetup group that also has about 11,000 people inside of our meetup.com group. And a number of different things, ways you can connect with us. So you can connect with us on our Facebook, on our website as well. And we have a number of different options for you in terms of just connecting with people, right? So that's what our main goal of our company, or our brand is to connect people and educate people all along the lines of multifamily investing. So let me see, Bethany, do you have anything that you could say also as well for our programs?
Absolutely. So we are always on the lookout for local individuals who'd like to start a local multifamily masters chapter meetup. Looks a little different now than it did pre-COVID. A lot of our chapters are doing entirely virtual or a hybrid type format for their meetups. And so please reach out to me if you have any interest in starting a local chapter. You can hit me up on Facebook. I can share my email address here in the chat too. And then also, we launched our MFM Mastermind program back in late of 2020. Check that out. Go to our website, MFM or multifamilymasters.com, and the link that says multifamily or MFM Mastermind, and you can fill out a link to apply for that. But we really seek to bridge the gap between that head knowledge or education about multifamily investing and actually getting started and getting your first deal and scaling. So definitely check out that program and fill out an inquiry form.
Okay, awesome. And so appreciate that, Bethany. And so you can also, Bethany, if you don't mind, would you be able to put some of those links inside of the chat?
Yeah, absolutely.
Okay,
also put
great.
a link into the Facebook group if my Facebook ever loads.
Okay, perfect. So just as a real quick intro, I'm just going to give you a little quick intro about me. Ferris will do one about him. I don't think Garrison's going to be here today, Ferris. So he won't be here today.
I saw the message. So. Garrison's, he's out sick. Okay. I'm sure everyone's a little heartbroken, but you get the other two parts of the team. So.
So very cool. So my name is Powell Chi. If you don't know me, I live in Los Angeles. I'm a multifamily and self-storage investor. Invested since 2017, bought my first multifamily. It was a 40-unit building in Indianapolis. All of my properties that I've invested in, I've been out of state. So after that, did another building in Indianapolis as well. And then from then on, did 5 different syndications. And now, I guess most recently, I've closed on a self-storage deal in January and actively looking to close more deals. So that's a little about me. How about you, Ferris?
Yeah, thanks, Pal. So for those that don't know me, my name is Ferris Musa. I have a company called Disrupt Equity. We basically buy and sell multifamily apartment complexes, and we syndicate the equity. We are vertically integrated. We do have our own management company as well. And we're coming up on 2,000 units that we've kind of bought and sold. So definitely love the business, continuing to grow. And like Pal mentioned earlier, people that you meet, right? And really, people that I met at meetups like this, right, really helped me propel kind of my growth or my. And so like Pal said, it's all about networking. We are, we are going to do a presentation at the very end. What are we doing, Pal?
We're going to be going to breakout rooms.
We're going to do breakout rooms. And then after that, we're doing the after party, right?
Yep. Then we have the after dark, MFM after dark.
Absolutely. So we've changed it up. People that have attended it before, the breakout rooms is really an opportunity to get to connect with a smaller group of people, right? Think, 5 to 8 people, but one-on-one versus, the 100 people that are in this channel. And so definitely look forward to that, right? And, part of it, because like Pal mentioned, it's all about networking. That said, right, today, our second right? We do this every third Monday of the month, once a month. And really the idea is to bring on very relevant, very, valuable speakers. And today's speaker, we have our friend Brandon Hall. We've had him on before, did a great job with it. And honestly, now the topic of today is something that I think is, I don't know who out there loves paying taxes. I think a few people will raise their hand for that one, right? And really, I got into real estate is just kind of the tax, very, very powerful vehicle. And, we figured it'd be a really good topic for people, especially this time of the year. And I'm so, definitely excited to have Brandon Hall. Brandon, thank you for carving out the time. I'm sure a calm month or two for you, right? And so definitely appreciate you carving out the time. And so with that said, Brandon, you want to go ahead and maybe kind of introduce yourself and kick it off?
Yeah, absolutely. I appreciate you guys inviting me on again. It's nice to see everybody. I think I actually see some familiar faces, so that's cool. I'm Brandon Hall. I run the Real Estate CPA. We are a CPA firm that services real estate investors. We provide tax planning, compliance, like preparation and accounting services. We have about 600 clients. All clients are in real estate, and we are nationwide. I have a team of like 22 or 23 people at this point. So we've grown out to be quite a cool crowd. We're 100% virtual. That was pre-COVID, so everything was paperless, and that's kind of how we've grown our firm. But we believe in trying to push out content, educate the masses, get people up to speed on how real estate tax works. What are the different things that you can be doing today to help you mitigate tax whenever it comes time to preparing your tax return at some later point.
Awesome.
Is it still me?
Yeah, it's still, you keep going. I mean, it's funny. So I actually had someone, coincidentally, a good friend of mine reached out today, basically saying, hey, who do you do for taxes? He's looking for someone with a little bit more knowledge, specifically around real estate. And so I thought it was very coincidental. I'm like, here's a link to our webinar tonight. And also here's his contact information. So, I think it's relevant. I think it's important to have the right CPA in your team, right? We always talk about kind of a team. I think CPA is as critical, if not more critical than, pieces as well.
Yeah. I mean, biasly, I'm going to say that I think that it's important to have a tax pro in your short or your small network of trusted professionals. But yeah, I mean, it's amazing. We see probably 100 or so landlords a week. We review their tax returns. Everybody's trying to come on board as a client, and we just see a lot of missed opportunities and mistakes. And it's nobody's fault. I mean, real estate taxation's really challenging. It's nuanced, and it can be really difficult to get everything right, even when you are doing it full time as a real estate accountant. So we see a lot of mistakes, and I'm just trying to help people understand what those mistakes are and how to have better conversations with their own tax advisors, so that you can mitigate those mistakes or maximize all the opportunities that you can otherwise hit. So today, what I'm going to do, is it okay if I launch into what we got? Cool. So I don't actually have slides prepared. I just figured we could talk about passive activity rules, real estate professional status. We'll touch on excess business losses. I'll tell you about one of the big mistakes that I've seen since the 2013 tangible property regs that almost everybody misses. And then we will end with what to expect with the Biden administration coming up, with the caveat that everything is a guess at this point. But let's start with the passive activity rules. So let me actually pull up. I do have some notes here. Cool. So the first thing to understand, actually, while I'm talking, go ahead and throw into the chat, put a 1 if you are buying your own rental real estate, like as a landlord. Put a 2 if you're investing passively as a limited partner, in like a syndication deal or something like that. So just go ahead and type 1 if you're a landlord, you buy your own rentals. 2 if you are investing passively as a landlord or as a limited partner. And I saw somebody in the chat, I think it was Rob Block. So you were talking about short-term rentals, vacation properties. I got something in here for you that you'll want to pay attention to. Okay, so we've got a lot of landlords. We've got a lot of people that are investing passively in syndication deals. Very good. So let's do this. First things first, to understand, every single dollar that you earn will be put into one of two buckets. It's the passive bucket or the non-passive bucket. And that's true for every single dollar that you earn. Every single dollar is either passive or it's non-passive. So we've got two buckets for income. And this is different than like portfolio income and earned income. That's all true too. But every dollar that you earn is either passive or it's going to be non-passive. The passive activity rules were implemented in 1986. They were implemented to stop the loophole of high income earners investing in real estate to reduce their tax burden. Because what people were doing is they were, I'd be a physician earning $1 million a year. I'd go buy a couple rental properties. I'd use the depreciation to wipe my income out, and I wouldn't pay tax, or I'd pay a really low tax compared to my total income. So Congress implemented the passive activity rules in 1986 to stop that loophole. So the passive activity rules say, if you have a passive loss, that loss can only be offset by passive income. So basically you look at that passive bucket. Passive income can offset passive losses can offset passive income, but any excess passive loss is going to be suspended and carried forward until it can be used by passive income, or until it can be offset by passive income at some later point, or until you sell the passive activity at some later point. So you're stuck with these passive losses that get suspended and they carry forward. And sometimes we see clients with like $300,000, $400,000, $500,000 worth of suspended passive losses that they're carrying forward on their tax return. And that's not a good thing, because at the end of the day, you want to claim those losses currently. And that's going to be true because of the time value of money theory. $1 today is better than $1 tomorrow. That's a fact. So if I can claim the losses today within reason, then I want to do that rather than having them be suspended and, pushing forward and kicking the can down the road. And I said within reason because, if I'm in the 37% tax bracket today, I definitely want to use my passive losses. If I'm in the 10% tax bracket, I might not want to use my passive losses. I might actually want to try to figure out at some later point, am I going to be in a higher tax bracket? And can I strategically plan for that year to utilize those losses? So the passive activity rules say passive activities can only offset passive activities. Passive income can only offset passive losses. Passive losses can only offset passive income. All rental real estate activities are passive unless you qualify as a real estate professional. So that's one of the rules within the passive activity rules. So it says all rentals are passive unless you qualify as a real estate professional. Secondly, any trade or business in which you don't materially participate is passive. So first, I have to look at all my rental activities. Every single rental that I own is passive unless I qualify as a real estate professional, right? So that's step one. Step number two, any trade or business in which I don't materially participate is also passive. So this is the passive activity rules for landlords. What it did is it said 1986, after that, you buy a new rental property, you do a cost segregation study, you get this big loss, and it's a passive loss because all rental activities are by default passive unless you qualify as a real estate professional. So it essentially just stopped this loophole. It stuck landlords with a lot of passive losses that they were unable to use, because rental real estate is typically going to produce a passive loss, a tax loss, even in years of operating income. And that's because of that depreciation. So I can have a rental that produces $3,000 of cash flow, so cash flow that actually hit my pocket, but I can tell the IRS that I lost $2,000 bucks, and that difference is generally due to depreciation. So because of depreciation, rental real estate, even in profitable years, can produce tax losses. Those tax losses, thanks to the passive activity rules, are by default passive unless I qualify as a real estate professional. And again, the second piece of that is any trade or business in which I don't materially participate in is also passive. So here's the thing. A lot of people will say, well, I'll go qualify as a real estate professional and then I'll be good. But what they forget is when you qualify as a real estate professional, you still have to hit that second piece, which is any trade or business that you don't materially participate in is still passive. So even if I'm a real estate professional on my rentals or for my rentals, I still have to show that I materially participated in my rentals to make them non-passive. And the entire idea here is to move my passive losses from that passive bucket and move it into the non-passive bucket. I want to move it into the non-passive bucket so that I can offset my W-2 income, my business income, my portfolio income. Like if you traded GameStop stock recently, right? Well, that's all non-passive. That's portfolio income. It's considered non-passive income. My passive losses for my rentals, they can't offset that type of income unless I can recharacterize it, move it into that non-passive bucket. And a way to do that is to qualify as a real estate professional. There's a few other ways to do it as well. You can earn less than $150,000 and you get a passive activity loss allowance, or you can just sell your rental activities and you'll be able to unlock any passive losses. But what we're going to focus on for the next few minutes is qualifying as a real estate professional. Because again, if you can qualify as a real estate professional, you get over the hurdle that all of my rentals are by default passive, right? So if all my rentals are passive, they're stuck in that passive bucket. Passive losses can only offset passive income. Excess passive losses get suspended and carried forward. Not ideal. So what do I want to try to do? Probably qualify as a real estate professional if your situation dictates that. So qualifying as a real estate professional, you have to spend 750 hours, personal service hours, in a real property trade or business or businesses, aggregate, 750 personal service hours in real property trades or businesses in which you materially participate. That's test number one. Test number two is that you spend more time in real estate and those real property trades or businesses than you do anywhere else. So let's talk about test number two first. More time in real estate than anywhere else. If you have a full-time job, 2,000 hours, you have to spend an additional 2,001 hours working in real estate. So that's 4,001 total working hours for the year. There's a few hundred tax court cases on real estate professional status. To my knowledge, around 20 or so folks, like 20 of those tax court cases are people with full-time jobs that tried to qualify as a real estate professional. Not one of them won. So nobody has proved to the IRS and to the tax court. Nobody's proved to the tax court yet that I can have a full-time job and I can also qualify as a real estate professional. So it's just hard for them to wrap their mind around. If you have a part-time job, let's say I work 1,200 hours during the year, and then I spend an additional 1,201 hours in real estate. Now I'm working 2,401 hours total. That's a little bit more doable, right? So part-time job, I might be able to hit that second test. But that second test is just important. Remember, I've got to spend more time in real estate than I do anywhere else. Sometimes people ask me, we work with a lot of physicians. So sometimes they'll ask me, well, I'm on 1 week and I'm off the next week. And I work 12-hour shifts while I'm on the 1 week. And then when I'm off the next week, I just do real estate. That's great. It doesn't matter your shifts, doesn't matter, the timing of your work. It doesn't matter. What matters is how many working hours you had at your job during the year or at your business during the year compared to the total number of real estate hours that you're working during the year. So that test trips a lot of people up, but let's assume that you can meet that test. Let's assume that you can spend more time in real estate than any other business or activity that you're participating in. Then the first test, that 750-hour test, that's the test that you really need to focus on. You've got to hit a minimum 750 personal service hours in a real property trade or business in which you materially participate. So if you can hit both of those tests, 750 hours in a real property trade or business in which you materially participate, in more than half your time, more time in real estate than anywhere else, you meet both those two tests, you're a real estate professional, and it means absolutely nothing for your rentals. All you did was you got over the default rule that your rentals are passive. You get the opportunity to prove that you materially participated in your rental real estate activities. So you got to qualify as a real estate professional. Then you have to also prove that you materially participated in your rental real estate activities. Material participation, there's 7 tests to material participation. The 3 that we see most often, from easiest to hardest. Easiest, your participation constitutes substantially all of the participation in the activity during the year. What does substantially all mean? No idea. Generally, there's a 30% threshold that's used for materiality throughout various pieces of the code. So we feel pretty comfortable that if you worked 70 hours and somebody else works 30 hours on your rental property, you've completed substantially all of the participation. There are tax court cases where people have worked 40, 50 hours on their rental properties, and they have been deemed to have been materially participating because they completed substantially all the work. Now, what does substantially all mean? Well, I can't have a property manager. I have to do it all myself. That's what kicks a lot of people out. A lot of people have property managers. When you have a property manager, there's no way you can be hitting that substantially all test because the property manager is completing substantially all the work. So you get kicked out of that test. So then you move to the next test, the next easiest test to hit. That test is 100 hours in more than any one other individual. And we take individual to also mean companies, like a property management company. So let's say I buy a rental and I have a contractor that comes out and works on it. And it's a big rehab project, huge rehab project. So the contractor spends 105 hours on the property during the year. Well, I'm going to self-manage it. I do everything else. I need to spend 106 hours. I need to spend 100 hours and more than any other person. So 106 hours because that contractor spent 105 hours. So if I can do that, I'm materially participating. So if I can't hit substantially all, then the next test is 100 hours more than anyone else. And let's say Powell and I are partners. We're not, but let's just assume that we are. Powell knows, because he knows these material participation rules. So he knows that he's got to work 100 hours and more than me in that partnership, right? To be materially participating. And I know, because I'm a CPA and I understand this stuff, that I've got to work 100 hours more than him. So what are we going to do? I'm going to work 101 hours. And he's going to go, okay, I got to work 102 hours, right? And then I'm going to go, well, I can't get beat. I'm going to work 103 hours. And we just stair step it, right? All the way up until we hit 500 hours. And that's that third test, 500 hours. So if you hit 500 hours, it's a safe harbor. You're deemed to be materially participating. Now, there's a lot of confusion around the material participation test compared to the real estate professional test. A lot of people say you can spend 500 hours materially participating and then 250 hours of anything else. Now, why would they say that? Well, 500 hours of material participation, that's the material participation test, one of the 7 material participation tests. 750 hours for real estate professional status. So they think that there's 2 separate types of hours. They think there's material participation hours, and then they think that there's real estate professional hours. So they'll say, instead of saying spend 750 personal service hours in a real property trade or business in which you materially participate, they'll say spend 500 hours in your real estate investing and then spend 250 hours of anything else. It can be education, can be research, can be investor level hours. And that's wrong. It's not correct, because it's 750 personal service hours in a real property trader business in which you materially participate. The material participation for real estate professional status is every single hour. Now, why the 500 hour thing gets messed up? Here's why. So I can be a real estate agent for 600 hours. And then I can spend 150 hours managing my rentals. Collectively, I hit the 750 hour test for real estate professional status. I'm a real estate professional, but I might not be materially participating in my rentals because I only spent 150 hours. So hopefully I hit the 100 hours more than anybody else test, but I definitely didn't hit 500 hours. So I might not be materially participating in my rentals, even though I'm a real estate professional. We run into this all the time with real estate agents, builders, flippers, developers, people that are not running real estate portfolios full time. It's a big problem because you'll go, hey, I spent 2,000 hours this year brokering. I'm a real estate professional. And I go, yeah, you are a real estate professional. Congratulations. Still means absolutely nothing compared to when we're talking about your rentals. Rentals are still passive. You have to materially participate in your rentals. That's where the 500 hour test, it's really important not to confuse the two. It's not saying I can spend 500 hours in my rentals and then do 250 hours of whatever else. That's not what it is. I've got to spend 750 total hours materially participating in real property trades or businesses. Now, there's 11 real property trades or businesses. I'm not going to name them all because I'm going to forget them, but we've got development, redevelopment, leasing, brokerage, rentals, management, acquisitions. So basically, like if you're actually doing something with a property, then you're good to go. You have a real property trader business, and you can aggregate all of your real property trades or businesses together for the purposes of testing that 750 hour test for real estate professional status. But when we're talking about our rentals, when we're talking about material participation, that 500 hour test, the 100 hours more than anyone else, substantially all, that's material participation. When we're talking about that, we're looking at each activity separately. So that's each rental separately, or it's each business separately. So I can spend 100 hours being a real estate agent. I may or may not be materially participating. I mean, you probably are, but maybe you're not. I can spend 100 hours managing my property. I may or may not be materially participating. So you have to look at, for material participation, you look at each rental separately. You do have the ability to make an aggregation election that groups all of your rental activities together into one. The reason that you would do that is so that you can look at the entire group of rentals for the purposes of the material participation test. Think about it like this. I have 10 rentals. I want to hit 500 hours of material participation on all 10 of those rentals. What does that mean? That's a 5,000 hour working year. Pretty darn tough. So what I do instead is I group all my rental activities together into one. So now all 10 rentals make up one activity for the purposes of material participation. So now I just have to spend 500 hours across the entire portfolio, and I will be deemed to have been materially participating in every single rental. Again, why is this important? Why is this important? Because I want the ability to run a cost segregation study, to claim bonus depreciation, and be able to take that loss. If I buy a $100,000 home and I run a cost segregation, let's not do that. Let's say I buy $1 million property, I run a cost segregation study, I'm going to get $250K in bonus depreciation that year with the way that the laws are written today. And that's going to create a $250K or so tax loss. Well, that tax loss is passive. So I can't offset my spouse's W-2 income or my spouse's business income. I can't offset my W-2 income or my business income. It's passive. Because all my W-2 income, business income, my spouse's W-2 income, business income, that's all non-passive. So I've got to recharacterize that bucket, got to move the bucket. And the way to do that is you qualify as a real estate professional and you materially participate in your rental portfolio. Now, the tests, again, for real estate professional status, 750 personal service hours in a real property trader business in which you materially participate, and more than half your time, more time in real estate than anywhere else. We talked about real property trades or businesses. We talked about material participation. Let's talk about what a personal service hour means. A personal service hour is not an investor hour. It's not an education hour. It's not a research hour, and it's typically not travel time. So if you think that you can log hours like listening to podcasts, networking right here, right? Going to the Bigger Pockets conference and meeting all your friends. If you think that those hours count towards being a real estate professional, they don't. There's many tax court cases that support this. There's Half-a-Pour versus Commissioner, where in Half-a-Pour, the taxpayer was going to a bunch of seminars. They were doing a bunch of research, and the tax court basically said, sorry, none of that time counts. The litmus test for whether or not the time is going to count is, does your hour affect the day-to-day operations of the rental? So if I can log hours, like a lot of people say, oh, well, you can do a lot of bookkeeping hours. Does that impact my rental's ability to collect rents or pay bills? The answer is probably not. Maybe, but probably not. So what hours do count? Property manager hours. Hours spent negotiating with tenants, structuring leases, marketing, advertising, doing repairs, doing rehabs, managing the property, managing the contractors at the property, coordinating everything, like being a property manager. If you're a property manager, or you're running, you don't have a property manager on your rentals, then the time that you spend is going to count towards real estate professional status 9 times out of 10. But the education time doesn't count, the research time doesn't count. And the investor hours are not going to count. The investor hours will count if you manage the day-to-day. So if you are the property manager, you do manage the day-to-day operations, then your investor level hours will count. The investor level hours are like reviewing financials, doing the bookkeeping, paying bills, tax returns, negotiating financing. That's investor level hours. If you're managing the day-to-day operations of the rentals, those hours will count. So personal service hours, 750 personal service hours in real property trades or businesses. You can look across all real property trades or businesses. There's 11 of them defined in the code. 750 personal service hours in real property trades or businesses in which you materially participate, and more time in real estate than anywhere else. You're a real estate professional. This stuff's relatively black and white. It's surprisingly not that gray. And it's not that great because it's like the second most litigated piece of the entire tax code. So it's definitely not something that you want to fool around with. We've helped with a lot of IRS audits. The number one thing that people lose on is research hours, believe it or not. Every single time, auditor comes in and says, sorry, research hours don't count. Your log consisted primarily of research hours. We don't buy it. The other thing that the auditors have been getting people on, I mean, it's apparent in tax court cases, but we didn't really realize it until we started helping out with audits, how apparent it is. If you create a time log during audit, you're pretty much toast. So you have to create a time log now and start logging your time today. And it doesn't have to be fancy. I mean, it can be a Google spreadsheet. You can also use your Google Calendar, or if you use Outlook, God bless you, but you can use Outlook, any sort of calendar app, something like that. You can document it. You just have to do it now. The IRS will push back on any sort of log that they think was done retroactively, and they'll tear it apart too. I mean, they'll dive into it and just call everything out, and you just won't stand a chance. So keep a time log, you date it. What property does it apply to? What category is it? Even if it is education and research hours, log it anyway. Just know that you're gonna have to back it out whenever it comes to that final count of the hours that you spent. And take notes. I always say to take notes. Take really good notes. Like so good that 5 years from now, if you have to take the stand in tax court, you can recall it. That's the level of notes you want to take. Don't do the whole, like, I'm going to send emails on my spouse's behalf because my spouse doesn't want to invest in real estate. That gets blown up in an audit. So don't do that. If you're going to do this, do it legit, do it straight and narrow, keep it straight and narrow, because it's a highly litigated piece of the code. That said, I will say the one piece of gray area, or the one gray area that I think still exists, as it pertains to real estate professional status, is travel time. I know I said that travel time doesn't count, and it typically does not count. In the IRS audit technique guides, the IRS has audit technique guides that they hand auditors, basically like a field guide. Here's how you step through and audit somebody. I mean, if you want to know how the IRS is going to audit you, you can literally Google IRS audit technique guide, passive activity losses, and it'll pop right up. It's a PDF. You can go through it. You can see everything I'm talking about to verify it. All cited, tax court cases, pieces of the code, everything. So that'll show you, how they audit you. And there's a few, actually, I don't have the quotes in front of me, but there's a few quotes that are interesting. Like, a rental property doesn't require a lot of management. We know that that's not true, because we all invest in real estate, but that's the frame of reference that they have whenever they're coming to audit you. So that's how important it is to make sure that you really bulletproof your documentation. But travel time, in that audit technique guide, they say very clearly travel time does not count, and they kind of leave it at that. But there have been tax court cases. There's one where it was lay versus commissioner. The taxpayer had a bunch of local rentals and was self-managing the local rentals and would travel to them, like drive to them daily. And when the taxpayer went up to tax court, they were like 100 hours short of the 750-hour requirement, and the tax court let the taxpayer go back and recalculate with the travel time included. So they'd excluded the travel time to and from their rentals. But there's other tax court cases. One recently, Lucero versus Commissioner in September 2020. Lucero had short-term rentals and would travel to them 6 to 8 times per year to do maintenance and cleanup work and repairs. And the tax court said, sorry, that travel time doesn't count. So there's not really clear guidance on what travel time does count and does not count. Our understanding, or our position, is that if the travel's local and you're self-managing your rentals, then it counts. Lay versus commissioner is a good citation for that. And if your travel is further away, where you're visiting infrequently, the travel time's not going to count for real estate professional status. Doesn't mean it still can't be a business expense. It can still be a business expense. It just might not count towards real estate professional status. So 2 separate pieces of the code. A little confusing, but keep that in mind. All right. I want to talk about rentals that are not rentals. Now, this is something that we have learned, I think, beginning of 2020. So Airbnb, over the past, 7 years, really, I mean, it's been around longer, but really the past 7 years, a lot of people have been acquiring Airbnbs, and we have this problem, tax problem of short-term rentals. How are short-term rentals taxed? How do they get included in this entire discussion? And early 2020, we had this onslaught of people with short-term rentals for whatever reason. I actually don't know why that was, but we had to start really digging into short-term rentals. And I wrote an article back in 2017 about short-term rentals, which we subsequently realized was not totally correct, because it's a relatively complex piece of the tax code. But short-term rentals, if your rental activity sorry, I'm not going to use rental activity. If your average customer stay is 7 days or less, average customer stay is 7 days or less, meaning I stay at your property for 6 days, Powell stays at your property for 8 days, collectively 14 days, 2 tenants, 7 days or less on average, right? So if your average stay is 7 days or less, you do not have a rental activity under Section 469. And remember, at the beginning of this entire thing, we said Section 469, the passive activity rules, that's what that is. The passive activity rules say all rentals are by default passive. All rental activities are by default passive unless you qualify as a real estate professional. But then we have this Treasury regulation that says if your average customer period of stay is 7 days or less, then you don't have a rental activity. So what that means is I don't have to be a real estate professional to take my losses on my short-term rental activity. I just have to materially participate because I don't have a rental activity. And the passive activity rules say all rental activities are automatically passive unless you're a real estate professional. This was confirmed in Lucero versus Commissioner, September 2020, that tax court case that I was just talking about. It was actually also confirmed back in, I believe, 2014, where the IRS came out and they said, oops, we were looking at this incorrectly, because there were two tax court cases. One, I believe, was in 2001 and another in 2011, where the tax court actually ruled incorrectly. They had an incorrect interpretation of the code, ruled against the taxpayer when they should not have ruled against the taxpayer. IRS later walked it back. I believe that was in 2014. So a short-term rental, an Airbnb, VRBO, it's not a rental activity under the passive activity loss rules. Sounds weird to say, but that's how it works. And if anybody is interested, because people go, oh, my CPA doesn't agree, I'm going to send you the code section in the chat where it's located. So there you go. So I just sent that out to everybody. You can, if you have a short-term rental, you can go to your tax accountant and say, hey, I was just on a presentation. These guys are saying that my short-term rental, I don't have to be a real estate professional to make the losses non-passive. So how can we get this done? So just because I don't have to be a real estate professional doesn't mean that it's automatically good to go. I mean, I still have to show that I materially participated in the short-term rentals. Now we're going back to those 7 tests. The first 3, I complete substantially all the activity or all the participation in the activity. I complete 100 hours and more than anyone else, or I spend 500 hours. So I've got to hit one of those 3 tests for that short-term rental activity. But if I could do that, then I have a non-passive activity. Cabins, beach homes, they typically go for about, the bonus depreciation on those is typically about 18% or so of the purchase price. The cool thing about this is that I can have a full-time job. I can buy short-term rentals and I can self-manage them. And as long as I do this in a smart way, I can show that I materially participated, and I can write the losses off against my W-2 income as non-passive losses. I don't have to be a real estate professional. Real estate professional status is what blocks me from having a full-time job, investing in real estate, and claiming my rental losses. But this is a way around that. And Lucero versus Commissioner in September 2020, that's exactly what they were trying to do. So that's a good one. And on top of that, your short-term rentals are typically going to be Schedule E property. They're not going to be Schedule C property. The only time that they're going to be Schedule C property are when you are providing substantial services to the tenants while they stay there. So if I come rent your beach home, you show up with breakfast, you're changing the linens daily, or you hire it out. You know, I get fresh linens every single day. The place is cleaned every single day. There's tour guides and that type of thing. Now you're providing substantial services. It's an actual B&B activity. Now you're on Schedule C. Now you're subject to self-employment taxes and all that good jazz. So that's when you're on Schedule C. Most people don't do that. Most people clean the unit after the tenant leaves. And if that's the case, you're not providing substantial services to the tenants while they're there. So it's a Schedule E activity. So you can be on Schedule E, where you have a quote unquote rental activity, but not a Section 469 rental activity. So it's Schedule E, but then it's also non-passive losses if you're materially participating. So really cool kind of workaround there on the short-term rentals. Short-term rentals are typically going to be 39-year property. So most rental real estate is depreciated over 27 and a half years. But short-term rentals are typically 39-year property. And that comes from the old transient basis rules that say that if your dwelling unit, if 80% of the gross receipts are from dwelling units, you have a residential property. But if more than 50% of the dwelling units are rented out on a transient basis, that's to a series of tenants that stay less than 30 days, then you have a non-residential property. Non-residential properties are depreciated over 39 years. Most short-term rentals are going to fall within that. The transient basis rules were actually removed from the code, but then I think it was either 2011 or 2013. There was an IRS, I think it was either a CCM or a memorandum that cited the old transient basis rules. So people have been citing that as a result. Basically, like the code still lives on, even though it technically doesn't exist anymore. So be aware of that. Now, since it's being depreciated over 39 years, the non-residential property, that also exposes it to, or I shouldn't say expose, that also gives you the opportunity to tap into various pieces of the code that changed with the 2017 Tax Cuts and Jobs Act. 2017 Tax Cuts and Jobs Act says that non-residential property, you can use Section 179 on roofs, HVAC units, fire protection systems, and like 2 other things. You can also 100% bonus depreciate qualified improvement property. Qualified improvement property is any sort of interior improvement that's not structural. So all of a sudden, my 39-year property Airbnb doesn't sound that bad because I can tap into these other things. All right. I'm going to keep moving. I see a lot of questions, and I'll come back to those in a second. Okay, two 2021 tax changes that I want to make you aware of. The first, 100% business meals are now available, open for business. You can now 100% deduct the cost of business meals. Previously, it was $50. It was 50%. So if I took somebody out to lunch and I spent $100, I could only deduct $50. The tax savings there might be $20. But now I can deduct the full $100. The tax savings have doubled effectively. So it's less costly to take people out to business lunches. That 100% business meal deduction is in place for 2021 and 2022 only. It's temporary, and it's going to go back to 50% after that. The purpose is to revitalize the restaurant industry over the next 2 years. So take advantage of that while it exists. The other one is excess business losses. So excess business losses, it was a new code section that was added with the 2017 Tax Cuts and Jobs Act, and it was kicked down. It was delayed. The CARES Act pushed it to 2021. So starting in 2021, you have excess business loss limitations. You can only claim, if you're married filing joint, a $500K excess business loss. What's an excess business loss? If I have business income of $1 from my CPA firm, and then I have business losses from my rental real estate of $2, so I have a $2 loss, my excess loss is $1, right? $2 for my rental real estate, $1 for my CPA firm, -2, +1. So my excess loss is $1. That's now capped at $500,000. So who does this hurt? It hurts real estate professionals. It hurts people that are buying $2 million buildings. They're getting a $600,000 bonus depreciation allocation. They're claiming a $600,000 tax loss. Well, now if they don't have any business income, they can't claim that full $600,000 tax loss. They can only claim $500K. That's who it's hurting. But be aware of that. If you're getting any big deals, especially if you're going to be allocated a large portion of the tax loss, or if you're buying your own deals, you just need to be careful. You need to plan for that upfront. So just be aware of that. All right. I'm going to I got like 2 more slides and, I got 2 more slides, and then I'll do questions real quick. Do I have enough time, pal?
Yeah, we'll help you. We got a bunch of the questions that we've already got a list for and everything.
Awesome.
So.
Cool.
Okay.
All right. Upcoming tax changes with Biden. So all of this is who knows, we're all guessing, but these are just things that either he has put into a plan that's a little bit more formal, or that he has mentioned during speeches, or that his administration has mentioned during speeches. All right. So the big one, or the big 3, the top tax rate is going to go from 37 to 39.6 if you're earning more than $620,000. You're going to be earning a lot of money to hit that top tax rate. The other one, the second one, is that long-term capital gains. This is one that's getting a lot of attention. Long-term capital gain rates are going to go from 20 to 39.6% if you're earning more than $1 million. I believe that's taxable income. So if your taxable income is more than $1 million, now your long-term cap gains are 39.6%. The third one is the Social Security payroll tax being added back in if you're earning over $400,000 in wages. So right now you pay Social Security and Medicare, a total of 7.65%. Your employer pays the other 7.65%. If you're unlucky enough to be self-employed, you pay a full 15.3%. You get to pay the employer and the employee half of the FICA taxes. You pay Social Security and Medicare up to, I think it's about $137,000 in wages or self-employment earnings. After that, you only pay the Medicare tax, 2.9% for self-employed, half of that if you're an employee, 1.45% if you're an employee. So on every dollar over that 137K threshold, you only pay the Medicare tax, 1.45%. What the Biden administration wants to do is they want to add that Social Security tax back in for every dollar in excess of $400,000. So for the first 137.5, you'll pay Social Security and Medicare tax, that full 15.3%, half that if you're an employee. 137 to 400, you'll only pay 2.9%. Again, half that if you're an employee. 400 and above, you pay the full 15.3% again. This could very effectively create, or I shouldn't say very effectively because I'm about to say the same thing, but basically if you're earning above 400,000, you might be facing like a 60% marginal tax rate, depending on what state you live in. So between Fed and state taxes, you can very easily be paying 65% once you factor in those self-employment taxes too. So I expect to see some, deferred comp plans coming or getting more attention in the coming years. Those are the three things that I expect to see happen. They've been talked about. They've been talked about with positivity from the administration. They seem to have a lot of support. I expect to see those things happen. I don't know when, but and they might not happen exactly the way that I described them, but I do expect to see some sort of scale there. The other three things that have been talked about a lot: eliminating the 20% pass-through deduction if you're earning more than $400,000. The 2017 Tax Cuts and Jobs Act added that 20% pass-through deduction for business owners, and the Biden administration wants to eliminate that if you're earning more than 400K. That has potential to pass at some point. The second one is potentially eliminating the stepped-up basis. So right now, if I buy a property for 100K and it appreciates to $500,000 over time, and then I die, my son inherits it. Right now, my son inherits it at a value of 500K. Right now, my son inherits it at a value of 500K. His basis gets stepped up. So he can either sell it at 500K and pay zero tax because his basis is also 500K, or he can start depreciating it at 500K and have it as a rental property. The Biden administration has talked about getting rid of the stepped up basis. So same scenario, I buy a property for 100K today. I die when it's worth 500K. My son inherits it. He inherits it at my basis, 100K. So he's got a gain of $400,000, assuming the property hasn't been depreciated in the past. So that can be, that's effectively a wealth tax. It's a death tax, but it's also effectively a wealth tax. It's been talked about a lot, but Biden is a moderate, and I don't know that he would actually go for something like that. So it'll be interesting to see how that plays out. The last one is the 1031 exchange. Everybody's talking about and worried about the 1031 exchange disappearing. The 1031 exchange has been on the chopping block for a long time. The way that this stuff works is, a congressman is going to say, I want this thing passed, and this thing is going to cost us X billion dollars in X billion dollars. And so we need to create revenue. So we have a team of tax attorneys that just literally go through the code and try to figure out how do we create revenue. Well, eliminating the 1031 exchange is a great way to create revenue. So that's why it always comes back up on the chopping block. But I don't think that it's going to be impacted, mainly because there have been studies in the past that show that the 1031 exchange does benefit the economy more than it wouldn't if it didn't exist. So I think that we'll be okay there. All right. Last but not least, the number one tax deduction that we've seen investors miss, and quite frankly, we've missed it with our own clients too, is called the partial asset disposition. This was implemented with the 2013 tangible property regulations. Partial asset dispositions, basically the way that it works is if I buy a rental property today for $100,000, the roof is worth, let's call it $6,000, $6,000. That's true with or without a cost segregation study, by the way, because if I buy a $100,000 property, I'm not just buying the building. I buy all the components that make the building up, and they all have value. Whether or not I get a cost segregation study done, that statement is true. So I can find the value of every component. It's a little bit more difficult without a cost segregation study, but that's true. That's how it works. So I buy this property, and let's say that the roof's worth $6,000. 2 years go by, and I say I need to buy a new roof. So I buy a new roof. I get it put on. It cost me 10 grand because I'm putting on 50-year shingles. Going for the good stuff. So 50-year shingles, new roof, gonna last me a long time. $10,000. Most people don't write the cost off of the old roof. That $6,000 old roof, they don't write it off. So what ends up happening? Well, they're depreciating the $10,000 new roof, and they're also depreciating the $6,000 old roof that no longer exists. So now they're depreciating $16,000 worth of roofs. And this is hard to see because if I haven't done a cost segregation study, I look at my tax returns and it says building 80,000, land 20,000, total price is 100K, new roof added 2 years later for 10 grand. Right? So I don't have that roof, that old roof identified to actually write off. But if you thought about it in a different way, it would make a lot more sense. So instead of saying my building is 80K, my land is 20K, I would say my building's 74, my roof is 6, my land is 20. So then when I go put a new roof on, I should probably scratch out that old roof that no longer exists. That's a partial asset disposition. Basically says you get to claim, you get to take a loss. You get to write off the cost, basically take a loss for the property that you've ripped out. The IRS is coming after people taking partial asset dispositions. Shouldn't stop you from taking them because it's definitely part of the code. It's something that is available to you. Anytime you're doing any sort of rehab improvements, anything like that, make sure that you touch base with your CPA and just ask them, can I claim a partial asset disposition? There's a lot of complex rules around it. Sometimes you can, sometimes you can't. Sometimes you have to use different calculations for different types of assets. Or different types of improvements, different types of repairs. So don't go do it yourself because these are very complex rules. All you need to remember is any year that I do an improvement, a big CapEx project, anything like that, I'm going to go ask my CPA if I can take a partial asset disposition. That's all you have to do. I encourage all of our clients to do it too, because we're human. We make mistakes and we don't do enough due diligence in the middle of tax season. That's going to be true for everybody. So help your CPA out and just ask him, can I take a partial asset disposition? And you will be pleasantly surprised with the additional deductions that you're able to claim. The other thing that partial asset dispositions really help with, when you go to sell a property, if I don't do a 1031 exchange or anything like that, I go to sell a property, I have to pay depreciation recapture tax on the depreciation I've claimed or could have claimed. But if I write the asset off, if I dispose of it via a partial asset disposition, it doesn't get factored back in at the end. So it's a double whammy. You get the benefit today, you also get it later. And that is it. So thank you so much for letting me come and talk to you guys. I really appreciate it. You can contact me in a number of different ways. So you can hit us up at therealestatecpa.com. That's www.therealestatecpa.com. You can email me at brandon.hall@hallcpallc.com. And I'll throw that in the chat too. And then we've got a tax and legal summit coming up. If you're interested in taking a look at that, it's an online event, totally free. www.taxandlegalsummit.com. Thank you.
Brandon, thank you. I feel like every time I listen to one of these, I always think I know it all, and then I pick up on something new. So I guess it's a good spot.
We covered a lot of ground in that 50 minutes.
Yeah, my head kind of hurts a little bit, and I knew a chunk of that. So, tremendous information. I know there was a ton of questions. I know Bethany was kind of collecting them, so we'll let her kind of go through and ones, right? I don't want it to drag out too long for you, Brandon, but would have totally appreciate if you stick around and answer some questions. And then for those that are listening, right, we'll hop on to our breakout rooms. Right, as mentioned, the breakout rooms is basically a chance to network. Hopefully Brandon can stick around. Maybe we'll get a little bit one-on-one with him and a chance to ask some more questions. And for those that have come live, right? We do this the third Monday of every month. Next month, we are going to be talking about new construction with new construction panel. So I'd love to see you all there. But with that said, Bethany, you want to go ahead and kind of take the stage and go ahead and ask the questions?
Sure.
Yeah,
Thanks, Hal.
before you go real quick, Bethany. So
Yeah.
Brandon, we're probably going to go to breakout rooms in about 15 minutes. So maybe if you could try to, some of these questions might be long, but if you could just give them maybe the 1 or 2 minute answer. And then if you need more information, for those of you who are asking for more information, you definitely have Brandon's information there. And I remember last time, Brandon, you also gave us like a white paper that you had. I don't know if that's something that you still have that, or that you could make available to people as well. So
yeah, that white paper it's actually on our website. It's publicly available. If you go to the realestatecpa.com, hover over education. We actually have a couple white papers, but I think that the one you're talking about is the ultimate guide to real estate professional status.
Yeah,
so
the
everything that
ultimate
I
guide.
talked about, everything I talked about, whenever I do these presentations, people always like pepper me with like, well, education and research and all that stuff. But that guide has all the citations and everything to back up what I'm saying. So
Perfect. Go ahead, Bethany.
Okay, awesome. Brandon, thank you so much as always for all the value you brought tonight. So one question that we did have from Nelson Lee, does looking for real estate to purchase count as hours towards being a real estate professional? And then also tangent with that, what does qualify as research hours?
Yeah, so that's a good question, and that depends. If you are underwriting a property, you're visiting the property to scope it out, during inspection, or you're walking contractors through the property, you close on it, then we would argue that those hours do count, the hours that you spent there. But if you're researching property, if you're underwriting a bunch of different properties, and let's say you do that 100 times and you close on one, there's nothing that has specifically addressed that yet in the tax court, but I would venture a guess to say that research time is not going to, that will be considered research time, and it's not going to actually count. There was a tax court case where a gentleman had a local portfolio, and he spent a ton of time going to auctions for foreclosure properties and researching those foreclosure properties and running numbers, and the tax court disallowed all of that time. So if you close on the property, you have a much better shot of substantiating the hours. Okay,
awesome. It's a great question from Omid. Does managing or promoting the property on social media count as real estate work, basically?
We would consider that advertising. It depends though, every once in a while we get somebody that's like, well, I have a blog, a real estate blog that I write all the time that funnels leads to my real estate listing, and that's going to be a stretch. So if you're like writing the Facebook ad to go and post it, then that's all part of advertising.
Mm-hmm. Awesome. Okay. Are the tax laws, this question from Jay Amin, are the tax laws just as favorable for self-storage and mobile homes, or is there a tax advantage of one particular asset class over the other?
So with tax, they all kind of work together in different ways at different times. If you're investing in mobile home parks, you can very likely get a 70% allocation to first year bonus depreciation with a cost segregation study. So I buy $100 million mobile home park. That'd be impressive. Buy $1 million mobile home park, I can take potentially $700,000 of bonus depreciation, and that can be big time. The problem is that in the future, that mobile home park, I've taken all that depreciation. So what's it going to do? It's going to produce passive income that's taxable, that I can't shelter because I've already taken all the depreciation. So, and that might not be a bad thing. Maybe that mobile home park produces $100K of passive income, and I go and throw $100,000 into a limited partnership syndication that's going to do a cost seg study, and they pass a $90,000 passive loss back, and now I'm offsetting my mobile home park's passive income. So it's not a bad thing to have passive income. It's just part of the planning the overall portfolio.
Gotcha. Okay. Next question from Daisy Serrano. If married and one person is the real estate professional, can the tax advantages also apply to the non-real estate professional partner?
Yes. Yep. Okay. So one spouse has to qualify as a real estate professional completely on their own. And if they do that, and then both spouses collectively can materially participate, which is cool. So if my spouse wants to just be a real estate agent full-time and doesn't want to touch the rentals, she can go do that. She can qualify as a real estate professional by being a real estate agent, and then I can manage the rentals. Well, she hit real estate agent or real estate professional status completely on her own. So we're good there. And then she gets to count my time for material participation in the rentals. As long as you do that, you're good to go. You can work together.
Gotcha. Awesome. Okay. Next question from Nelson Lee. If you travel out of state to manage a rental property, does that travel back and forth count?
Well, that's the big question mark, right? So we know that if you have local properties and you're traveling locally, then you're good. We also know that if you are infrequently visiting out of state properties or just properties that are a long way away from you, long way being, a 2-hour drive, then you might not be good. Is there an in between? I'm sure that there is, and we'll know what that looks like, I'm sure, over the next 5 years or so.
Gotcha. Okay.
Hey, wait, real quick.
Mhm.
Hey, Brandon, can I follow up on the question before?
Sure.
If one person is married, the other person is a real estate professional.
Yeah.
You mentioned that material participating. So one partner could materially participate and basically cover the full 500 hours. What if that person has a W-2 job? Does that person, is he disqualified, or can that person still have a W-2 job and do the 500 hours?
That's a great question. And this is where the difference of the real estate professional tests and the material participation test come into play, because there's no rule with the material participation test that says that you have to spend more time materially participating in like real estate than anywhere else. That's only on the real estate professional test. So if a spouse hits the real estate professional test, they're a real estate professional. I can work full-time at my CPA firm full-time, right? Like I've spent 3,000 hours a year working at my CPA firm. So full-time and a half at my CPA firm, but I can still find time to manage the rentals. And if I'm self-managing and I do everything myself, my spouse can count all my time for material participation purposes.
Okay. Thank you.
Does that answer your question? Okay, cool.
Okay. Let's see. We're doing about 10 more minutes for Q&A, right, Powell? For breakout rooms?
Yes.
Awesome. Okay. Next question from Omid. If you have a W-2 corporate job, can you classify for a real estate professional if you hit the 750 hours?
Can you repeat that? I'm sorry.
If you have a W-2 corporate job, can you classify as being a real estate professional if you hit the 750 hours?
If you have a full-time corporate job, that's where that second statutory test comes into play, where you have to spend more time in real estate than anywhere else. So you would have to be able to show that you spent more time working in your real estate business than you did your W-2 job. You would have to track time. Like your time log would have to show how much time I spent at my W-2 job. And this is also true for part-time. If you're part-time anything, you need to track time in all of your activities, not just real estate. That's the trick with that time log. So I would have to track time in my W-2 job. I would also have to track time over here running that rental real estate portfolio or just whatever real property trader business I'm running. If I spend more time in my real property trader business, I'm good to go. But also note that you will most likely be audited and most likely taken to tax court, because the auditor's never going to believe that you spent more time in real estate than your full-time W-2 job. So just be ready to put up a fight. I'm not going to say that it can't be done, because I'm an optimist. It just hasn't been done yet.
Love it. Awesome. Going along with that question, is there a particular format or program for a time log spreadsheet that you'd recommend, or just something simple like an Excel spreadsheet?
Yeah, good question. We always say whatever's going to get you coming back to the table on a daily basis to record your time. So if that's spreadsheets, it can be Google Sheets. We have a lot of clients that use Google Sheets because they can put it right on their phone. So figure out what works. You can use calendars. You can use actual timekeeping tools. Like there's one like Toggle, T-O-G-G-L, that a lot of people have used with success. So figure out what works for you. But the key is just every day I'm putting something down on what I did to document it.
Perfect. Okay. Next question from Jefferson Gann. For a limited partner that is purely passive and also not a real estate professional, what would you say would be the best way to lower tax burden aside from a cost segregation study?
Yeah, so that's a loaded question. Typically, it's very difficult to do if all you're doing is investing in a limited partnership. You're going to get the passive losses back from that syndication when they do the cost segregation study, and those passive losses are going to be suspended and still on your books. Now, what we have done with some success, I say some because it's difficult to do, is help our clients think through the timing of the investments that they're making. So if I make an LP investment today, and I know that this hold period is expected to be 4 or 5 years, I know that come year 4 or 5, I should have the next $100,000 ready to go to make the next investment, because when this investment that I make today liquidates, it's going to come back with a big gain, and I'm going to want to offset that gain by investing in the next limited partnership. So it's more of like a timing thing and just trying to get my portfolio to offset each other for tax purposes over time. But there's some other issues with that too, like basis erosion that happens when I keep recycling my money and getting all the bonus depreciation and stuff like that. So you got to watch out for that as you continue scaling it up. But that's definitely something that you can do. It's just a matter of kind of talking it out with your CPA and understanding when are these properties expected to liquidate, so that I can have a game plan in that year to hopefully mitigate that passive income that's coming back to me.
Okay, awesome. Thank you. Next question from Jay Amin. Any thoughts on investing in multifamily syndications as a limited partner through a self-directed IRA? Better tax advantages, or just a headache using a custodian that charges too many fees?
Yeah, I mean, look, I think that if you want to use retirement accounts to invest in real estate, go for it. And this is not financial advice. I'm not a financial advisor. Me personally, I don't know that I would use a retirement account to invest in multifamily assets or single family assets, because those assets are already relatively tax sheltered. What I would use my retirement accounts for is to invest in like hard money lending, private lending, because I'm going to earn interest income, and interest income is really difficult to shelter if it's not in a retirement account. So why not get the interest income? Debt exposure is good. So why not do that? De-risk myself across my entire portfolio, and get the interest income kicking back. If you invest in a multifamily syndicate or any type of syndicate, any type of real estate syndicate with a self-directed IRA, you're going to have to worry about UBTI, unrelated business taxable income. Unrelated business taxable income, well, rents from rental real estate are not subject to UBTI. What happens with a self-directed IRA is that self-directed IRAs are subject to UDFI. That's unrelated debt financed income. So basically, if I use my self-directed IRA to buy a property and that property is leveraged with debt, then some portion of the rents are automatically going to be subject to UBTI. So I might pay some tax. A solo 401k is not subject to UDFI. So if you can, use a solo 401k to invest in syndicates, because then you don't have anything to worry about. You don't have UBTI, UDFI, nothing. If you are using a self-directed IRA, in our experience, there's no, like, I can't point to any specific data, but in our experience, it seems to lop off about 1% of the total IRR over the hold period that the tax does. So I don't know if that's helpful, but.
Yeah, perfect. Okay, thank you. Let's see, next question. Just have a couple more here from Nelson. As a syndicator, does the time spent prior to closing with lenders, investors, et cetera, count towards hours for real estate professional activities?
Yeah, that's a great question. I probably, but maybe not.
Okay.
And the only reason I say that is if you, so think about any syndication deal that you're part of, there's typically 1 or 2 people in that deal that are actually running the deal. Those people are real estate professionals most of the time. If I come in and all I'm doing is bringing capital to the deal, then I sit on the property manager calls, I don't need to be there. My time's probably not going to count. But if I'm doing that enough and I'm doing that through my own company will probably qualify as a real property trader business, and all those hours will probably count. So that's why I say like probably, but maybe not. It just kind of depends on your situation.
Gotcha. Okay. Awesome. I think this is a follow-up question to Nelson's.
Maybe one last one here, Bethany,
Okay.
for the last one. Okay.
What if you are on the loan? I think that's a follow-up to what we were just discussing from Nelson.
You mean like with the UBTI, UDFI thing?
Yes.
Yeah. So it doesn't matter if you're on the loan. Well, if you're investing with a self-directed IRA and you're on the loan, I think you might have bigger problems than than tax. But theoretically, even if you were, it wouldn't matter for UDFI purposes, because UDFI just looks at the property that's acquired. Is it leveraged? If yes, you have UDFI, and any net income coming back is some portion of it will be subject to UBTI.
Gotcha. Okay. Clarification, no, he actually intended on a Freddie or Fannie loan.
Yeah, it's not going to matter.
Okay.
Still debt, still leverage. Yep. Good
Awesome.
question.
All right. Well, thank you.
Awesome. Well, thank you so much for everybody who participated, as well as you, Brandon, for dropping tons of knowledge for us once again here on Multifamily Masters Live. We really appreciate that. Do go to, if you have any follow-up questions, or that Brandon wasn't able to answer your question, feel free to reach out to him. He has his contact information in the chat. And so let's see, right now we're going to go ahead and go into our breakout room sessions. We'll typically go into our breakout room for about 10 minutes ish. It's a good chance for you to come on the screen, put your information in there, meet some people, and and kind of network here right at the end. Right after that, we'll basically come back here, close it up right before 7 o'clock, and then from there we will, for those of you who have Clubhouse app, we will be on Clubhouse for a little bit, maybe an hour at the most, and kind of answer any Q&A as well as dive into other topics around multifamily as well. That's our MFM After Dark on Clubhouse that we'll be running. So if you have any questions, feel free to follow up there, but we're going to go ahead and break you out into some breakout rooms right now, and look forward to seeing you guys all next month, third Monday of the month, and we'll be talking about new development then. Okay, so we'll head to our breakout rooms now. All right.